All right, guys, welcome back for another video. This will be one of the most important videos I upload because it represents a macro pivot. You may have noticed the title of the video is Italy defaulted. Of course, they didn't really default. They defaulted in nominal terms, but it does represent a crisis in the Eurozone, and I'll revisit that later. But first, I want to start with the Japanese 10-year government bond yield. And the Bank of Japan has committed publicly for some time to keeping the 10-year yield below 0.25%. So if you put it, just roughly 0.25% on the chart, you can see that anytime the yields get above the 0.25% level, the Bank of Japan, the central bank, steps in and buys bonds. Remember, they have unlimited purchasing power because they can create an unlimited amount of their natural currency, the Japanese yen, to purchase these bonds. So they do have an unlimited amount of buying power. Now, the political situation in Japan is to keep the yield at this level, for multiple of reasons. Two major reasons being that, an exporting country like Japan benefits from having a weaker currency. So there is a incentive to keep the currency weak through bond purchases, but also one of the reasons why is because you have a little bit of an aging economy in Japan, and in order to finance the government, the Bank of Japan has to commit to these bond purchases. But the secondary effect of that is very significant is that there's so much interest rate risk embedded in the Japanese banking system because they believe because the Bank of Japan has committed to defending these yields for so long, they see it as an impossibility for yields to rise above 0.25%. And, in one sense, there's a lot of logic in that because they're being defended by the central bank of their country. But because of that assuming that that's not possible, whenever anybody assumes something's not possible, then they don't allocate, they don't manage risk in that direction. So because of that, in the Japanese banking system, you have all this risk that has basically the banks they become sellers of volatility. Anytime the interest rates get above 0.25 or the yields get above 0.25, they become an interest rate seller in volatility. And that's embedded in the Japanese banking system. And it's a structural problem. Most of them aren't even, straightforward about how much interest rate volatility risk is in the system. But basically, they're all volatility sellers. And if yields were to, rise materially, and for whatever reason, the Bank of Japan was no longer able to defend those yields, then basically the Japanese banking system would collapse because of that systemic risk. And there's a few factors weighing on that risk. One of the things is that, when Japanese bond yields are this low, it encourages people to borrow Japanese yen and then sell dollars. So you can borrow the yen cheaply, and then that's your way to generate liquidity. So you have a lot of people playing the spread between, say, the Japanese yen and the dollar. And anytime you have divergence in central bank policy, like here where you have the Japanese central bank pursuing a totally different policy than the Federal Reserve, that increases volatility because people come in, arbitrage the spread, and that adds to the systemic pressure and risk. Now, one interesting thing to consider is that, in order for the Central Bank of Japan to be able to pursue this policy indefinitely, because remember, they have unlimited purchasing power, but there's not an unlimited amount of bonds. So there could be a scenario where the Bank of Japan buys every single bond on the market and there's no bonds left to buy. And in that case, the Japanese government would have to issue new debt just to be able for the central bank to have something to purchase. So the Bank of Japan may get into a debt jubilee where, their inflation spirals out of control, and now they're, issuing debt just to pay, to give credits to citizens to pay for their gas and pay for their housing, and then those bonds, so that there's bonds on the market for the central bank to purchase. Again, kind of a crazy outcome, but a very real possibility. Now pivoting back to the Italian market. So basically, the euro is having a crisis, and the ECB announced, I think back in April, that they were going to stop their bond purchases. Well, the fiat system in Europe is so weak that that lasted about 2 months or 3 months. Um, so it's been about 3 months since April, and uh, now you have this Bloomberg article: ECB bond tool having no limits as steeper rate hikes loom. Basically, Christine Lagarde and the ECB have committed to unlimited bond purchases, similar to what the Bank of Japan is doing. We just talked about with the Japanese 10-year bond yield. Now they're starting to do the same thing in the ECB. Um, so the only reason I posted this out on Twitter is this guy, JJ Cycles. He's pretty good I would give him a follow on Twitter. But really, the point is to look at this article. Again, the liquidity that was being pumped into the system by the Bank of Japan is kind of small compared to the rest of the world. But when you have the ECB, I mean, the ECB is considerably large. When you have them jumping in and doing unlimited bond purchases, they're going to quickly devalue their currency. And the reason why they're doing this is because um, basically the Southern European countries are at risk of default. If the European Union, the Northern European Union states don't debase their currency to subsidize the debt of the Southern European states, the European Union is going to disintegrate and it's going to fall apart, which means no more euro. So, oddly enough, in order to defend the euro, the ECB has to devalue the euro to keep the Southern European countries solvent and keep them in the European Union. And the reason why I said Italian debt or Italy is defaulted is because Italy is the prime suspect. So it is a Southern European problem. They call them the pigs. Uh, you know, uh, your Italy, Greece, Spain, uh, those type of countries. But primarily Italy. Italy, I believe, has approximately 25% of all the Eurozone's debt. So, it's primarily a Southern European problem. Northern Europe has to subsidize Southern European debt. But within those Southern European countries, Italy is the prime culprit. And, you had the prime minister stepping down a few days ago. The situation is really bad. Um, so that's why the situation is so extreme that now you have them countering with very extreme measures. And anytime the central bank uses the word unlimited, I think you you don't want to that I wouldn't take that word lightly. I mean, it quite literally is unlimited. They can have an unlimited purchasing power. They can purchase an unlimited amount of bonds because they can print an unlimited amount of euros, and the euro is the second largest currency in the world. Um, so that's something to keep in mind. And here's just a reading from the article, the Bloomberg article. So the Europeans ECB's unlimited tool, the European Central Bank will unveil an unlimited bond buying tool next week to help markets better adjust to steeper and faster interest rate increases than previously thought. Economists surveyed by Bloomberg say almost 80% predict the instrument known as the Transmission Protection Mechanism will carry like conditions for governments as used to help. Nearly all expect the liquidity its purchases create to be reabsorbed in a process called sterilization. Bundesbank President Joachim Nagel has said the latest measure should only be used in exceptional circumstances and under narrowly defined conditions. So basically, what they're doing is they're rebranding monetary debasement and quantitative easing with this new branding called TPM, or Transmission Protection Mechanism. Again, if something is unpopular, you just rebrand it, and it takes a while for everybody to figure out what's going on. You know, uh, so basically, what they're doing is they're buying these insolvent governments' debt, with the explicit expectation that this, with strings attached, that they remain in the European Union and abide by the policies of the European Union in exchange for this bailout. And this is really important, right? this is sovereign default. So we're getting into some pretty extreme territory, especially considering, you've got the European energy crisis. Europe doesn't have enough energy to heat its citizens over the winter. I know the winter is kind of far out, but that is a problem coming up. And, it's exacerbated by the Russian Ukraine war. I think that's kind of how some of these more insolvent countries are being pushed over the edge by this crisis. Um, Europe has some pretty big issues on their hand. They don't have a lot of choices. I think when when the central banks historically, when they're facing a doomsday scenario, I mean, they're historically their go-to has just been to debase currency and print money and engage in monetary debasement, and that's exactly what they've announced they're doing right now. Of course, they've rebranded it and you know called it by a new name, but it's the same unlimited bond buying purchases you've seen in previous crises. Now, where it gets interesting is if you have Japan and Europe, both, you know, debasing their currencies, and as well as a lot of other developed nations who have to debase their currency, go into the open market and purchase dollars to satisfy their dollar-denominated debt. You have all these countries debasing their currency except for the U.S. So it kind of, or at the very least, at a much accelerated pace relative to the U.S. So it creates a dynamic where, the U.S. may reach a situation where they need to step into the foreign currency markets and start buying these foreign currencies to support the foreign currencies from totally collapsing. So you may actually see a situation where the Federal Reserve, the Fed, is able to engage in quantitative easing, and abroad by purchasing their allies' debt, by purchasing their allies' currency, like like the Japanese yen and the euro, and simultaneously be able to maintain their political anti-inflation stance of rising interest rates back at home. And they can say that with a straight face, that they're not printing money, at least domestically, right? They can go into the foreign markets and pursue a different policy path than they are pursuing domestically. And that is an interesting development, or at least would be. Again, we're not there yet, but I don't think that there's the Federal Reserve wants to maintain the strength of the dollar, but they're in a situation where if they pursue the current course, the dollar will just keep spiraling until every currency, other currency destroys itself and collapses into the dollar. And ultimately, that is not good for the Fed. They need to maintain the other currency markets, and they need to prop up their allies. Again, this is not a prediction, just a thought experiment. What is very real is the fact that the European Union is buying unlimited bonds. Don't let that fool you. That is inflationary. That that fuels government spending that gets injected directly into the economy, and that reduces yields and ultimately reduces interest rates. And maybe maybe the cost of borrowing is more expensive in the U.S., but it's becoming extremely cheap in the ECB, or will be coming extremely cheap with on the back of this purchase program, as well as in Japan. So just something to keep an eye on. I know, we tend to get hyper focused on the American market, and it is ultimately the most important. But in a market like the ECB, although it is a secondary market, it is the most important market besides the U.S., and it has a lot of extreme entanglements with the global economy. So definitely something to keep an eye on. I hope you guys like this video. Again, just leave a like on the video, subscribe to the channel, and I'll catch you guys in the next upload.